Most people think they're doing the right thing by saving money. They're not. Right now, millions of people are watching their savings quietly shrink. Not because the number in their account goes down, but because the money they worked hard to earn is buying less and less every single month. The account looks fine. The damage is invisible. This video is going to break down every savings rule that used to work and explain exactly why each one died. Not to scare you, to save you. Because the old rules were built for a world that no longer exists, and following them in 2026 could be costing you thousands of dollars a year without you even realizing it. Let's get into it. The first rule that died: cash is always the safest place. This one sounds so logical that almost nobody questions it. Cash doesn't crash like stocks. It doesn't go to zero. It feels safe. But here's the problem. Safe from what? In April 2026, inflation was running at 3.8% year over year. If your savings account is paying the national average of 0.38%, your real return is negative 3.3%. Your balance goes up slightly. Your purchasing power goes down significantly. Put $10,000 in a 0.38% account and you earn $38 in a year. But inflation quietly eats about $329 of your real purchasing power. You didn't lose money on paper, you lost money in reality. Cash doesn't crash, but it can bleed slowly every single month. The better rule: divide cash by purpose. Immediate cash for bills, emergency cash in a high-yield account, longer-term cash in something that actually competes with inflation. But that brings up the second dead rule, and this one might sting a little. Keep all your savings at your main bank. Banks built their entire business model around this idea. One relationship, one login, one big mistake. The national average savings rate right now is 0.38%. Many high-yield savings accounts are paying around 4%. Some top rates are pushing 5%. On $50,000, the difference between those two numbers is roughly $1,810 per year, every year, just for not moving the money. The bank is not rewarding your loyalty, it is monetizing your laziness. The modern rule is simple: keep your checking account at your main bank for bills and everyday spending, but move your emergency savings somewhere that actually pays you. Speaking of checking accounts, Rule 3 is dead too. A checking account is fine for savings. Interest checking accounts average 0.07% nationally. On $25,000, that earns you about $17.50 per year. At 4%, that same $25,000 earns $1,000. That's not a rounding error. That's a utility bill. That's part of a vacation. That's real money gone because of where the money was parked. Checking accounts are financial parking lots. Your emergency fund should not live there permanently. Checking is for money that will move soon. Savings is for money that should earn. Now here's one people almost never think about. Any savings account is good enough. This used to be roughly true when all savings rates were low and close together. That era is over. The gap between average and competitive accounts is now massive. The FDIC national average sits at 0.38%. Top high-yield savings accounts are paying around 4% to 5%. On $100,000, that gap is the difference between earning $380 and earning $4,000 to $5,000 in a single year. The new saving skill is not just saving money, it is placing money where it is treated well. Compare APY at least every few months. A good bank is not always a good savings rate. Those are two completely different things. Here's where it gets interesting. Drop a comment below. How often do you actually check the rate your savings account is paying? I'm genuinely curious.
Rule 5. Never use CDs because your money gets trapped. CDs got a bad reputation because people thought of them as rigid and boring, but in a high-rate environment, they solve a specific problem really well. If you have $30,000 set aside for a car purchase next year, leaving it at 0.38% earns about $114. A 12-month CD at 4.25% earns about $1,275 before taxes. Same money, same timeline, completely different result. CDs are not dead. What is dead is using them blindly or avoiding them blindly. The rule is simple. Don't lock up your emergency fund. But for planned expenses with a known timeline, a CD can protect you from falling rates and earn you significantly more while you wait. Rule 6 might be the most widely repeated piece of advice in personal finance. Save 3 to 6 months and stop thinking about it. The goal is still right. The structure is wrong. A modern emergency fund should be layered by speed. Some money needs to be available instantly. That's your checking buffer. Some can take 1 to 2 business days. That's your high-yield savings. Some can sit in short-term CDs or Treasury bills. That's your deeper reserve. Bankrate's 2026 Emergency Savings Report found that 60% of Americans were uncomfortable with their emergency savings. The issue isn't just having savings, it's having enough accessible savings in the right places. The one-account emergency fund is what died, not the emergency fund itself. Rule 7, if the money is in an app, it's basically in the bank. This one is genuinely dangerous and almost nobody talks about it. Payment apps are built for payments, not storage. The CFPB has warned that funds sitting in payment apps can be at risk if the company fails, and they often don't carry individual federal deposit insurance the way a bank account does. Venmo is not a savings account. Cash App is not an emergency fund. Use payment apps for payments. Transfer idle balances back to an FDIC insured bank or NCUA insured credit union. This is a simple habit that could protect you from a situation you never see coming. Rule 8, FDIC insurance means I never have to think about bank risk. FDIC insurance is real and it's powerful, but it has a ceiling. The standard coverage is $250,000 per depositor, per insured bank, per ownership category. A single person with $400,000 in one savings account at one insured bank has $150,000 sitting above that limit. A married couple with a properly titled joint account may have higher coverage because ownership categories matter, and most people never read the rule book. FDIC insurance is not unlimited, it is a rule book. And if you have large cash balances, the question is not just, is this bank FDIC insured? The question is, exactly how much of my balance is insured right now? Rule 9. Money market funds are the same as bank savings. The phrase money market can mean two completely different things, and confusing them is a real mistake. A bank money market deposit account is FDIC insured up to the standard limits. A brokerage money market mutual fund is not FDIC insured. It may have SIPC protection as a security, but that is a fundamentally different kind of protection. Same two words, completely different structure. Understand the wrapper before you assume the protection. Rule 10, save first, pay debt later. This rule breaks down the moment your debt carries a high interest rate. Credit card accounts were assessed interest at 21.52% on average in Q1 2026. If you're carrying $5,000 at that rate, you're paying about $1,076 per year just in interest. A separate $10,000 savings account earning 4% produces about $400 per year before taxes. You cannot outsave a 21% credit card. The math simply does not work. Keep a small emergency buffer so you're not one flat tire away from more debt. Then attack toxic debt before building oversized cash reserves. That's the modern version. Rule 11. A PY is a number that matters. A PY matters, but it's the headline, not the whole story. Interest from savings accounts is generally taxable income, so a 4% APY on $50,000 earns $2,000 before tax. At a 24% federal rate, you keep about $1,520 before state taxes. If inflation is 3.8%, the real after-tax gain may be very small, or even negative depending on your tax bracket and state. One thing worth knowing, interest from Treasury bills is exempt from state and local taxes. For savers in high-tax states, That can make a Treasury bill genuinely more valuable than a bank CD with a higher headline rate, thinking after tax, after inflation terms. That is the real number. And the final rule that died. Savings accounts are simpler than investing, so there's nothing to manage. This might be the most expensive belief of all. Savings rates move constantly. They follow Federal Reserve policy. They follow competition between banks. An account that was great last year may be average this year with zero notification. The modern saver doesn't need to trade stocks every day, but they do need to stop ignoring cash. Do a quarterly cash audit. How much is in checking? How much is in emergency savings? What APY is it earning? Is any balance above FDIC limits? Is any money sitting idle in a payment app? What cash do you need in the next 30, 90, or 365 days? That one habit, done 4 times a year, is worth more than almost any other financial move you can make. Here's the number that puts all of this together. Someone with $250,000 in a national average savings account at 0.38% earns about $950 per year. At 4%, they earn $10,000. The difference is $9,050 annually, before taxes. That is the lazy cash tax. It is invisible. It is silent, and it compounds in the wrong direction every single year. The old savings rules were built for a world where banks were simple, inflation was low, and high-yield accounts weren't accessible to regular people. That world is gone. The new rules are not complicated. Compare rates. Layer your emergency fund. Understand what's insured and what isn't. Think after tax. Do a quarterly audit. If this video changed how you think about where your money is sitting, share it with someone who needs to hear it. And if you want to go deeper on any of these topics, high-yield savings, CD ladders, Treasury bills, there's a video on this channel for every single one. The money is yours. Make sure it's working as hard as you are.